Something unusual is happening in the markets right now. And if history is any guide, what comes next could catch most investors completely off guard. Gold just hit another all-time high. And you might be thinking, so what? The stock market is hitting record highs too. But here's what Wall Street isn't telling you. Gold is crushing stocks. And the last 5 times this happened in the past 100 years, a major market event followed within months. I'm talking about 1929, 1973, 2000, 2008, and 2020. So the question isn't if something is coming. The question is what. And more importantly, are you prepared? What's up, everyone? Z here. In this video, I'm breaking down exactly what's happening when gold outperforms stocks, why it matters to your portfolio, and the 3 moves smart investors are making right now before the herd catches on. And make sure you stick around to the end because I'm going to share the one asset class that historically does best in the next phase of this cycle, and it's probably not what you think. Let's dive in. Section 1, the warning signal. The data that's freaking out Wall Street. Here's the number that has analysts worried. Over the last 5 years, the S&P 500 is up 88%. Not bad, right? But gold? Gold is up 180%. That means gold has doubled the performance of stocks. Your stock portfolio, even if it's making money on paper, is actually losing purchasing power when measured against real assets. Think about that. You're making money, but getting poorer at the same time. What this ratio actually means. There's something called the S&P 500 to gold ratio. It tells us how many ounces of gold it takes to buy 1 share of the S&P 500. In the year 2000, it took 45 ounces of gold to buy the S&P 500. Today, it takes just 1.4 ounces. That's a 97% collapse in the relative value of stocks compared to gold. Now, you might be thinking this is just some random financial metric, but here's why it matters. When gold crushes stocks, it's not because gold is becoming more valuable. It's because investors are losing confidence in paper assets. And that loss of confidence, it always precedes something big. Section 2, the pattern. History doesn't repeat, but it rhymes. Let me show you the pattern. 1929-1932, the Great Depression. Gold outperformed stocks. Market crashed 89%. Took 25 years to recover. 1970-1974, stagflation era. Gold crushed stocks. Inflation hit 12%. Unemployment and recession combined. 2000-2002, dot-com crash. Gold started outperforming. Tech stocks collapsed 78%. S&P fell 50%. 2007-2009, financial crisis. Gold was the warning signal. Real estate and stock crash. Global banking system nearly collapsed. 2020, COVID pandemic. Gold spiked first. Markets crashed 35% in weeks. Unprecedented money printing began. See the pattern. Every single time gold significantly outperforms stocks, a major disruption follows. Why this happens? It's actually simple economics. Gold is money, real money. It's been money for 5,000 years. Stocks are bets on future earnings in dollars. When gold beats stocks, it means investors are saying, I don't trust these paper promises anymore. Give me something real. That shift in sentiment, that's your early warning system.
So what's driving this now? 3 forces pumping gold. Force number 1, central banks are de-dollarizing. China, Poland, Turkey, India, they're all loading up on gold at record pace. Why? Because they're preparing for a world where the dollar isn't the only game in town. When central banks dump dollars and buy gold, that's not a vote of confidence in the U.S. economy. Force number 2, the debt spiral. The U.S. national debt just crossed $36 trillion. We're adding $1 trillion in debt every 100 days. How do you pay back debt you can never repay? You print money. And printing money makes gold more valuable and dollars less valuable. Force number 3, real inflation. Not the official CPI number, real inflation. Housing is up 50% since 2020, food is up 30%, insurance is through the roof. Gold is reflecting the real loss of purchasing power, not the manipulated government statistics. Section 4, what happens next? The 3 scenarios. Based on historical patterns and current data, here's what's likely coming. Scenario 1, market correction, 60% probability. 20 to 30% stock market pullback, flight to safety assets, recession fears dominate headlines, gold continues rising. Scenario 2, inflation surge, 25% probability. Government keeps printing, stocks rise in nominal terms but fall in real value. Gold explodes higher. your dollars by less and less. Scenario 3, currency crisis, 15% probability. Loss of confidence in the dollar, international trade disruptions, gold goes parabolic, system-wide restructuring. None of these scenarios are good for traditional stock-heavy portfolios. The silver lining. Here's the good news. If you know it's coming, you can position for it. The investors who make generational wealth aren't the ones who avoid crashes. They're the ones who prepare for them and capitalize when everyone else is panicking. Same in 2008, same in 2020, same in 2022. The bottom line? Gold beating stocks isn't just a fun financial trivia, it's a warning signal, a flashing red light that says something's about to change. You have two choices. Choice 1, ignore it. Hope it's different this time. Keep doing what everyone else is doing. Choice 2, prepare, diversify, position yourself to not just survive what's coming, but to thrive because of it. History shows us that massive wealth transfers happen during market dislocations. The question is, are you going to be on the right side of that transfer?